Hello, Marc Ostwald from ADM Investor Services International, with some thoughts this week to try and distract a little bit from those US-China trade talks, which are everyone's obsessing about, particularly with the 15 December tariff deadline, and indeed the UK election on the 12th of December, and start to think about some of the other things which have been happening this week and obviously relevant in terms of, above all, the UK election. Namely, we've had the announcement of a supplementary budget in Japan, and that comes after the recent report from the International Finance report on government debt or on overall global debt levels. So my first chart is really just to highlight just how much the low interest rate environment, QE and ZIRP and NIRP, have contributed to a very rapid increase in global debt levels. We've gone from about 170 trillion in the immediate aftermath of the global financial crisis to a projected 255 trillion this year. And we are obviously looking at a situation where we're looking for that to increase quite substantially more, at least in terms of general government debt. So how does this look in G7 terms? So on the next chart, what we have, I think, is just sort of somewhat instructive. The right-hand scale, by the way, is Japan. The left-hand scale is the other three countries, or three areas which we've got on here. So as one can see, Japan already has a debt-to-GDP ratio of 237%. That will certainly vault over the 240% mark with this supplementary 25 trillion budget. The USA, as one can see, has been escalating quite rapidly. We're now up at 104.3%, thanks to the big spending of Mr. Trump. Euro area is perhaps the surprise here, largely a function of what's been going on in Germany, but overall debt to GDP has fallen to 85.4%. While in the UK, which was in a much better position than the euro area just 10 years ago by a very large factor, we are looking at a fairly flat profile over the last 5 to 7 years due to austerity, and now a fairly rapid increase post-election, assuming that we do actually have a majority government which can enact a lot of those spending plans. So how does this then play out in terms of G7 government bond yields? So on my third table, what one can see is we've got a fairly flat curve structure in a lot of countries. The US, 159 to 179. Germany, obviously somewhat steeper, but still very flat, minus 0.64 in 10-year terms to minus 0.23, minus 0.01 in 10-year terms, and plus 0.21 in the longer end. But in Japan, we still probably have the flattest structure of all, minus 0.15 for 2-year, plus 0.434. It has been flatter than that. But does that have implications? Well, the first thing that one notices on that 30-year part of the curve is that there are a number of countries which now have 30-year debt which yield below that of Japan, and that has some implications. So we come to my final chart of the day, and that is the 30-year JGB, 30-year bond yield spread. And as one can see, there's been quite a sharp move. I think one of the most important things is to note is Japan has for a long time always had a pickup going into any part of other yield curves. Now that is not the case in the long end. And at some stage with the extra borrowing, perhaps not necessarily in Germany, but the extra borrowing elsewhere, we are going to need to see a bit more of a risk premium to attract those Japanese investors, and probably an overall bigger risk premium for the extra government borrowing that we've got. So something to think about beyond trade wars and Brexit.